There was a gentleman I was talking to over coffee, and I had to leave very rudely and abruptly. You asked a question about why 5 years. Do you mind repeating your question again to kick it off?
I was getting at the point that digital businesses don't tend to, they change so frequently. Successful digital businesses, in my opinion, are built for the customer. So what the customer wants isn't necessarily known from the beginning. It's what you want. And to value a company in 5 years' time based upon what are we making. If you take Facebook, for example, equally Twitter, there are companies out there. I mean, there are obviously smaller companies, which not everyone will know. There are companies out there which you can't value how much they're going to make because they still don't know all of the different revenue streams because they change every 2 weeks if they're using agile methodologies, which a lot of the companies now and successful attractive companies or investors are using. So how can you value it in 5 years' time realistically?
You're going to ask me to answer that, aren't you?
We are.
Well, I think actually in the last sort of 4 or 5 years, we now have plenty of examples of companies still getting investment where actually the business model is still not known and still not validated in a way that perhaps historically 10 years ago it was much easier to do. So I think fortunately now investors are happier to take a risk on businesses when they don't know what kind of business model it is, and we'll see in the future whether these people like Twitter, etc., will get a business model and the returns will come back from the investment. I think the reason for 5 years, though, is actually more to do with the more professional end of the market, the VCs, the companies that have got money from other people in terms of the funds they're managing, is those funds, the lifetime of that fund is invariably between 5 and 7 years where they will need to get a return back to the original investors. So I think that's why there is a focus on 5 years rather than that it takes 5 years to grow a company. Mm-hmm. So that's why companies look at, or funds will be interested in a 5-year plan from you.
Which I think says something else about your research into the funds who are looking to invest in you. You need to know how far through their 10-year cycle, that's 5 years to invest and 5 years to realise on those investments. You need to know how far through that cycle they've got, because that will condition the timescale and time horizon that they might want their return from.
And I also think in digital as well, there are, as we talked earlier, a vast array of sources of money now. You don't necessarily have to go to a traditional VC that will look at this 5 to 7 year return. The other investors, angel investors, high net worths, will look for a different profile.
We have a 5-year exit strategy because of the fund closes in 5 years. So, but going back to your original point about business models, we haven't 100% pinned our business model, but we know we're making sales, but there's a big conversation of whether we give the brands away for free so we can get to critical mass and then we become attractive for acquisition, or we implement a very kind of strategic tier system of what the brands are worth and how we make revenue from on-demand fulfillment. So there's kind of two schools of thought on the board at the moment.
If you don't mind me asking, when you first raised finance,
mm-hmm.